We saw another strong risk-on month for shares, with global share markets posting strong returns for the month of March and remain at near all-time highs. International shares are up 5.09%. Australian shares underperformed global shares, returning a solid 2.3% for the month. Month to date, global shares are up 3.7%. Australian shares are up 2.9%. We also saw further evidence of Australia's job market revival. ANZ Australian job ads rose more than 7% for the month of March and are now 23% above those levels during COVID-19. Furthermore, job ads have hit a 12-year peak. Unemployment levels have continued to fall from the pandemic high of 7.5% to currently 5.8%. And it was much the same in the US. The US labour market added 916,000 jobs in March amid the fast-paced coronavirus vaccine rollout. The unemployment rate fell to 6%, having fallen from a high of 14.8% last April. But there is still 8.4 million jobless as compared to pre-pandemic levels. Bond yields retreated. The US 10-year bond yield has eased back to 1.66%, having peaked at the midway point through March at 1.75%. After equity markets fell sharply due to concerns around a spike in inflation and the probability of interest rate increases earlier than anticipated. While there is still a risk that bond yields may continue to rise and increase equity market volatility, we are of the view spare capacity in the US economy should keep inflation pressures under control until 2023. US President Biden unveiled a US $2 trillion infrastructure, jobs and education stimulus package. While some have expressed concerns about whether too much stimulus is being introduced, this package is different and faces several hurdles. The key differences include the stimulus package is to be spread across an 8-year timeframe, and that corporate and high-income tax increases are expected to fund part of this spending program. Such tax increases make it difficult to pass through Congress, especially with some Democrats already voicing their concerns. However, infrastructure spending should support the broader infrastructure asset class. Global manufacturing activity continues to rise strongly. Chinese PMIs, a measure of manufacturing activity and a good indicator of economic activity, recovered in March to 51.9, indicating a continuation of China's economic expansion. US manufacturing PMIs for March were also strong, beating expectations, reaching 64.7, the highest since 1983. The new orders component of this report hit its highest level since 2004. We also saw a record number of US companies issuing positive earnings guidance. According to FactSet, 60 S&P 500 companies have issued positive earnings per share guidance, well above the 5-year average of 35, and the best since tracking began in 2006. The IT sector has the highest number of companies issuing positive earnings per share guidance. This is an important indicator, not only because it supports Q1 2021 earnings, but it also supports the current strength of the equity market rally and current elevated equity market valuations. And now onto our investment strategy and outlook. It's hard to argue why equity markets won't keep rallying from here on. We expect shares to hold up well and generate reasonable returns over the short to medium term. A recovering and momentum-driven global economy, solid company earnings, elevated savings and pent-up demand, low interest rates for at least another 3 years, news about effective vaccine rollouts, and the US's sizable stimulus packages, both existing and new, should support equities over the next 12 to 15 months. It's still very important to monitor the macroeconomic environment, staying nimble and moving quickly when opportunities present themselves with respect to asset classes and asset allocation strategy. We still anticipate more upside potential in cyclical sectors such as airlines, tourism, financials, airports and transportation sectors relative to tech and healthcare. But we note that there's been a broader rally in cyclicals and COVID beneficiaries over the recent weeks. Our overweight position in small caps should continue to provide an important source of alpha for our client portfolios. A lower interest rate environment and an improving economic outlook for Australia should continue to support small cap returns. We continue to expect the Australian dollar to continue its journey upward and benefit from the upcoming super cycle. We maintain our strategy of hedging our foreign currency exposure.